So, you're thinking about buying a home in Canada. It's a huge deal, right? Probably the biggest financial decision you'll ever make. And it all starts with that one big word, mortgage. Today, we're going to demystify the whole thing. We're giving you a step-by-step map that'll take you from feeling confused to feeling confident, and finally, to becoming a homeowner. I mean, it is so overwhelming, isn't it? All the jargon, the paperwork, the massive numbers, it's enough to make you feel totally lost before you've even started. That's the exact feeling we're going to tackle head on. So let's chart that course. Think of this explainer as your personal GPS. We're going to navigate through all the most important landmarks in the mortgage world, so you have the confidence to actually move forward. Okay, so our journey begins with the most fundamental question of all. What can you actually afford? Before you even start daydreaming about houses, you have to get real about your own financial picture. And that conversation really starts with one thing, the down payment. This is simply the chunk of cash you need to bring to the table yourself. It's the first big financial hurdle. And trust me, the size of that down payment is going to have a huge ripple effect on your entire mortgage journey. So how much do you actually need? Well, there's a set formula in Canada for the absolute minimum. You need 5% on the first $500,000 of the home's price, and then 10% on any amount above that. So let's take that example of a $650,000 home. You'd need $25,000 for the first part, and then another $15,000 for the second part. Add them up, and your minimum down payment is $40,000. All right, next up, we've got something that sounds a little intimidating, the mortgage stress test. But really, you can just think of it as a financial fitness test. The government wants to be absolutely sure you could still handle your payments, even if interest rates were to jump up in the future. It's a pretty important safety net. And here's the crucial part you gotta understand. You don't qualify at the interest rate your bank is actually offering you. Nope. Instead, you have to prove you can handle payments at a much higher what-if rate. You'll be tested against either your contract rate plus 2% or the government's benchmark rate. And here's the kicker. You have to pass the test using whichever of those two rates is higher. All right, so let's say you've crunched the numbers, you've passed that stress test, and you know your budget. You've officially reached the next landmark on our map, choosing the actual mortgage product that's the best fit for you. And right away, the path kind of splits in two. It all comes down to that magic number, a 20% down payment. If you have 20% or more, great, you're on the path to what's called a conventional mortgage. But if you have less, you're heading toward a high-ratio mortgage, and that comes with a legal requirement, mortgage loan insurance. Okay, next big decision, fixed rate or variable rate. A fixed-rate mortgage is all about security. Your payment is totally predictable. It won't change for the whole term. A variable rate, well, it moves with the market. That means you could save some serious cash if rates fall, but you're also taking on the risk that they could rise. It's a classic trade-off, right? It really comes down to this. Do you value that peace of mind, or are you willing to take on a little risk for potentially greater savings? And then there's another choice you have to make, open or closed. An open mortgage gives you maximum freedom. You can pay off a huge chunk or even the whole thing anytime you want without getting hit with a penalty. But you pay for that freedom with a higher interest rate. A closed mortgage, on the other hand, is cheaper, but it's way less flexible. You'll face penalties if you try to make big extra payments. Now, here's something that trips a lot of people up, the timelines. You're going to hear two words all the time, term and amortization. So, think of your amortization as the entire mortgage marathon, say 25 years. Your term? That's just one leg of the race, typically 5 years. And at the end of each term, you have to renew your mortgage at whatever the new interest rates are, which is always a really key moment. So we've charted the main path, but what about finding some shortcuts on that map? Let's talk about how you can pay your mortgage down faster and potentially save yourself tens of thousands of dollars while you're at it. I mean, who wouldn't want that, right? It's such a powerful idea. By paying your mortgage down more aggressively, you're not just getting out of debt sooner, you're also cutting down the total amount of interest you're going to hand over to the bank over the life of that loan. And it's not a small difference we're talking about. Just look at these numbers. On a relatively modest $120,000 loan, just by choosing to pay it off over 15 years instead of the standard 25, that borrower saves almost $30,000 in interest. $30,000. That is a huge deal. So, how do you actually do it? Well, there are 3 really common ways to get ahead. You can make lump sum payments whenever you get a bonus or maybe an inheritance. You can just increase your regular payments, even by a little bit. Or you can switch to what's called an accelerated payment schedule, which is kind of clever. It basically sneaks in one extra full payment every single year without you really feeling it. Okay, we're on the home stretch. Finally, let's talk about protecting this massive investment you've just made. Now, this is where a lot of buyers get really confused, so we're going to make the different kinds of mortgage insurance crystal clear. Okay, listen up because this is the part that trips almost everyone up. But the distinction is actually pretty simple when you ask one question. Who is being protected? Mortgage loan insurance, that's the one that's mandatory with a small down payment. It protects the bank if you default. It does nothing for you. Creditor insurance, on the other hand, is an optional product that protects you, the borrower, by helping cover payments if something terrible happens, like death or disability.
But, and this is a big but, there's a really important catch with that optional creditor insurance. The money, the payout, it goes straight to the lender to pay down the mortgage. Your family doesn't get the cash. They don't get to choose how to use that money, which is a massive difference when you compare it to a personal life insurance policy.
And that's it. There you have it, your map to the Canadian mortgage landscape. We've plotted the course through affordability, all the mortgage options, the short putts to pay it down faster, and the insurance to protect the whole shebang. What might have seemed like this big, scary, overwhelming thing is hopefully a lot clearer now. So the only real question left is, what's your first step on the journey?